Credit score in the United States. A credit score is a number that provides a comparative estimate of an individual's creditworthiness based on an analysis of their credit report. It is an inexpensive and main alternative to other forms of consumer loan underwriting. Lenders, such as banks and credit card companies, use credit scores to evaluate the risk of lending money to consumers. Lenders contend that widespread use of credit scores has made credit more widely available and less expensive for many consumers. Under the Wall Street Reform Bill passed in 2010, a consumer is entitled to receive a free report of the specific credit score used if they are denied a loan, credit card, or insurance due to their credit score. History. Before credit scores, credit was evaluated using credit reports from credit bureaus. During the late ERS, banks started using computerized credit scoring to redefine creditworthiness as abstract statistical risk. 447 The Equal Credit Opportunity Act banned denying credit on gender or marital status in 1974, along with race, nationality, religion, age, or receipt of public assistance in 1976. 573 Credit scoring adoption accelerated to shield against discrimination lawsuits. 585 During the ERS ends, the credit reporting industry relentlessly consolidated. 598 And moved aggressively into prescreening. 602 The FICO score burst into public consciousness in 1995 when Freddie Mac had lenders use credit scoring for all new mortgage applications. 607 Credit scoring models. Although various methods of estimating creditworthiness existed before, modern credit scoring models date to 1958, when Bill Fair and Earl Isaac created credit application scoring algorithms. Their first credit scoring system, FICO score, was first introduced in 1989 by FICO, then called Fair, Isaac, and Company. The FICO model is used by the vast majority of banks and credit grantors, and is based on consumer credit files of the three national credit bureaus, Experian, Equifax, and TransUnion. Because a consumer's credit file may contain different information at each of the bureaus, FICO scores can vary depending on which bureau provides the information to FICO to generate the score. Credit scores are designed to measure the risk of default by taking into account various factors in a person's financial history. Although the exact formulas for calculating credit scores are secret, FICO has disclosed the following competence: payment history percentage, best described as the presence or lack of derogatory information, bankruptcy, settlements, charge-offs, repossessions, foreclosures, and late payments can cause a FICO score to drop. Burden percentage. This category considers a number of debt-specific measurements. According to FICO, there are 6 different metrics in the debt category, including the debt-to-limit ratio, number of accounts with balances, the amount owed across different types of accounts, and the amount paid down on installment loans, length of credit history, or time in file percentage. As a credit history ages, it can have a positive impact on its FICO score. There are several metrics in this category, most significantly the average age of the accounts on a report and the age of the oldest account. Types of credit used percentage. Consumers can benefit by having a history of managing different types of credit. Examples of types of credit include installment, revolving, consumer finance, and mortgage. Recent searches for credit percentage. Hard credit inquiries, or hard pulls, which occur when consumers apply for a credit card or loan, revolving or otherwise, can hurt scores, especially if done in great numbers. Individuals who are rate shopping for a mortgage, auto loan, or student loan over a short period, 2 weeks or 45 days, depending on the generation of FICO score used, will likely not experience a meaningful decrease in their scores as a result of these types of inquiries, as the FICO scoring model considers all of those types of hard inquiries that occur within 14 or 45 days of each other as only one. Further, mortgage, auto, and student loan inquiries do not count at all in a FICO score if they are less than 30 days old. While all credit inquiries are recorded and displayed on personal credit reports for 2 years, they have no effect after the first year because FICO's scoring system ignores them after 12 months. credit inquiries that were made by the consumer, such as pulling a credit report for personal use, by an employer for employee verification, or by companies initiating pre-screened offers of credit or insurance, do not have any impact on a credit score. These are called soft inquiries or soft pulls and do not appear on a credit report used by lenders, only on personal reports. Soft inquiries are not considered by credit scoring systems. These percentages are based on the importance of the 5 categories for the general population. For particular groups, for example, people who have not been using credit long, relative importance of these categories may be different. Makeup factors are limited to the individual's past and continuing behavior on credit. Contrary to common misconception, other financial factors such as age, employment status, assets, or income are not accounted. However, lenders are not prohibited from asking about and accounting these factors for particular lending considerations. Suggesting a higher credit limit can help a credit score. The higher the credit limit on the credit card, the lower the utilization ratio average for all of a borrower's credit card accounts. The utilization ratio is the amount owed divided by the amount extended by the creditor, and the lower it is, the better FICO rating in general. So if a person has one credit card with a used balance of $500 and a limit of $1,000, as well as another with a used balance of $700 and $2,000 limit, the average ratio is 40%, $1,200 total used divided by $3,000 total limits. If the first credit card company raises the limit to $2,000, the ratio lowers to 30%, which could boost the FICO rating. There are other special factors that can weigh on the FICO score. Any money owed because of a court judgment, tax lien, etc., carries an additional penalty, especially when receiving one or more newly opened consumer finance credit accounts may also be a negative. There are several types of FICO credit score: classic or generic or general purpose score, industry-specific scores, bank card score, auto score, mortgage score, personal finance score, and installment loan score, XD score, next-in risk score, and ultra-FICO score. The classic FICO credit score, named FICO credit scores between 300 and 850, and I percentage of people have between 700 and 850, I percentage have between 740 and 850, and percentage of Americans held the highest FICO score, 850, in 2019. According to FICO, the median FICO credit score in 2006 was 723 and 721 in 2015. The average FICO score 8 in the U.S. was 710 in 2020 and 716 in April 2021. The FICO bank card score, FICO auto score, FICO personal finance score, and FICO installment loan score are between 250 and 900. The FICO mortgage score and FICO score XD2 are between 300 and 850. Higher scores indicate lower credit risk. Experian classifies FICO credit scores lower than 580 as very poor, as fair, as good, as very good, and as exceptional. Equifax considers FICO scores lower than 580 as poor, 580 669 is fair, 670 739 is good, 740 799 is very good, and 850 is excellent. Individuals with FICO scores less than 670 are seen as subprime borrowers. Each individual actually has over 60 credit scores for the FICO scoring model, as each of the 3 national credit bureaus, Equifax, Experian, and TransUnion, has its own database, but the most used are 40. Data about an individual consumer can vary from bureau to bureau. FICO scores have different names at each of the different credit reporting agencies: Equifax Beacon, TransUnion FICO Risk Score, Classic, and Experian FICO Risk Model. There are several active generations of FICO credit scores: FICO 98 1998, FICO 4 2004, FICO 8 2009, FICO 9 2014, FICO 10, and FICO out 2020. A new type of FICO score named UltraFICO score was released in 2019. The FICO 95 credit score released in 1995 and Equifax FICO 98 scores are no longer in use. The Experian FICO 98 score is named FICO Score 2, Experian FICO 4 score is FICO Score 3, TransUnion FICO 4 score is FICO Score 4, and Equifax FICO 4 score is FICO Score 5. The FICO Score XD is made with alternative data and was released in 2016. Mortgage lenders use EXFICO Score 2, EQFICO Score 5, and TUFICO Score 4, but not a real FICO mortgage score. Consumers can buy their FICO scores plus credit report for Equifax, TransUnion, and Experian from the FICO website MyFICO, and they will get their FICO Score 8, FICO Bankcard Score 8, FICO Auto Score 8, FICO Score 9, FICO Auto Score 9, FICO Bankcard Score 9, and other FICO scores 1998 and 2004 versions. Individuals can get up to 28 FICO scores 10EX, 9EQ, 9TU on MyFICO. Consumers also can buy their FICO Score 8 for Equifax in the website for that credit bureau, and their FICO Score 8 for Experian on its website. Anyone can register and get their free EXFICO Score 8 with Experian CreditWorks Basic. Other types of FICO scores cannot be obtained by individuals in a personal capacity, only by lenders. Some credit cards issued by banks and some credit unions offer a free FICO score several times per year to their cardholders. FICO Next in Risk Score is a scoring model designed by the FICO company for assessing consumer credit risk. This score was introduced in 2001 FICO Scorange, and in 2003 FICO Scorange, the second generation of NextIn, was released. In 2004, FICO research showed a percentage increase in the number of accounts above cutoff while simultaneously showing a decrease in the number of bad, charge-off, and bankrupt accounts when compared to FICO traditional. FICO Next-In score is between 150 and each of the major credit agencies markets this score generated with their data differently. Experian, FICO Advanced Risk Score Equifax, Pinnacle TransUnion, FICO Risk Score NextGen, FICO Small Business Scoring Service SBSS score is used to evaluate small business credit applicants. This score can evaluate the personal credit report of a business owner along with the business credit report of the business itself. Financial information of the business may be evaluated as well. The score range for the FICO SBSS score is: a higher score indicates less risk. Applications for SBA 7 loans for $350,000 or less will be pre-screened using this score. A minimum score of 140 is needed to pass this pre-screen, though most lenders require scores of 160 or more. In 2006, to try to win business away from FICO, the three major credit reporting agencies introduced VantageScore Credit Score, which differs from FICO in several ways. According to court documents filed in the FICO v. VantageScore federal lawsuit, the VantageScore market share was less than 1% in 2006. The VantageScore methodology initially produced a score range from 501 to 990 VantageScore 1 score and VantageScore 2 score, but VantageScore 3 score adopted the score range of in 2013. The VantageScore 4 score was released in mid-2017 and also uses a range of. Consumers can get free Vantage scores from free credit report websites and from some credit cards issued by Capital One, American Express, U.S. Bank, Chase Bank, TD Bank, N.A., Synchrony Bank, and USA Bank. The VantageScore 3 and 4 lower than 550 is very poor, is fair, is good, and is excellence score is published by CE Analytics. This score is distributed to 6,500 lenders through the Credit Plus network. It has a range of 350 to a number of scores have been developed to help consumers understand and improve their credit scores. Most were introduced before FICO began sharing details of their model and encouraging lenders to share scores with consumers. While these scores can help consumers monitor and improve their score, These scores do not replicate the FICO score and may be substantially less accurate if they use less complete data. They also assign different score ranges and rankings to consumers, which has created confusion among consumers who expect to have a single score number. Discussions on the MIFICO forum and elsewhere have referred to non-FICO scores as FAKO score. Experian has the plus score between 330 and 830, and Experian's national equivalence score ranges from 360 to 840. Equifax has the Equifax credit score of between 280 and 850. Credit Expert offers a simulation score to estimate the impact of various actions on a score range of 350 to lenders may choose to use non-FICO credit scores to gain additional insight on consumers, especially those with limited traditional credit history who might be difficult to score. These scores may be added to the FICO score if they provide unique insights, or used instead of the FICO score if they provide similar predictiveness. Most of these scores are based significantly on data not available through the National Credit Bureau's alternative data, such as rental, utility, and telecom payment data, or public record information such as property deeds and mortgages, liens, personal property titles, tax records, and licensing. Off Credit Optics score by SageStream blends traditional and alternative credit data with machine learning modeling techniques and ranges from 1 to 999. LexisNexis ResView score, based on wide-ranging public records, ranges from 501 to 900. CorrelLegit Credco reports on property-related public records, and its Anthem credit score ranges from 325 to 850. PRBC allows consumers to self-enroll and report their own non-debt payment history. The PRBC alternative credit score range is 100 to 850. There are also scores like ChexSystem's consumer score designed for financial account verification services ranging from 100 to 899. The LickLink credit score by Lick Inc. ranges from 300 to 850. Scorologics LLC offers the JSS credit score, which assesses credit risk based on job history, income, and the impact of the economy. A behavioral risk score 0 to 999 is used by Community Bank and Community Capital Bank. TU Credit Vision scores and TU New Account Score 300-850 are issued by TransUnion. The latter is used by WebBank. Free Annual Credit Report. Main article: Comparison of free credit monitoring service as a result of the FACT Act. Fair and Accurate Credit Transactions Act. Each legal U.S. resident is entitled to a free copy of his or her credit report from each credit reporting agency once every 12 months. The law requires all three agencies, Equifax, Experian, and TransUnion, to provide reports. These credit reports do not contain credit scores from any of the three agencies. The three credit bureaus run annual credit report.com, where users can get their free credit reports. Non-FICO credit scores are available as an add-on feature of the report for a fee. This fee is usually $7.95. As the FTC regulates this charge through the Fair Credit Reporting Act. The FTC tracks various scams and reports on other sites that provide fake credit reports or charge fees for their services. Instances of illegal behaviors by credit report services have been settled in court, such as that of Experian Consumer Direct, that was charged with deceptively signed people up for credit report monitoring services that charged them monthly fees. Non-traditional uses of credit scores. Main article: Insurance score. Credit scores are often used in determining prices for auto and homeowners insurance. Starting in the BRRs, the national credit reporting agencies that generate credit scores have also been generating more specialized insurance scores, which insurance companies then use to rate the insurance risk of potential customers. Studies indicate that the majority of those who are insured pay less in insurance through the use of scores. These studies point out that people with higher scores have fewer claims. In 2009, TransUnion representatives testified before the Connecticut legislature about their practice of marketing credit score reports to employers for use in the hiring process. Legislators in at least 12 states introduced bills, and 3 states have passed laws to limit the use of credit check during the hiring process. Criticism and controversies. Main article: Criticism of credit scoring systems in the United States. Credit scoring systems have garnered considerable criticism from various media outlets, debtors' unions, consumer law organizations, and government officials. Discrimination against prospective employees, rejection of rental applications, racial bias, poor risk prediction, manipulation of algorithms, and overall immorality are some of the concerns raised regarding the system. The scoring system has also been studied as a form of classification to shape an individual's life chances, a form of economic inequality. The classification scheme is necessitated by the loss of collective social services and risk. The credit scoring system in the United States is similar to the social credit system in China. The use of credit information in connection with applying for various types of insurance or rental applications has drawn criticism because obtaining and maintaining employment, housing, transport, and insurance are among the basic functions of meaningful participation in modern society, and in some cases, such as auto insurance, are mandated by laws. Credit reporting companies have been accused of illegal behaviors by misstating costs and usefulness of credit scores, tricked consumers into recurring payments, and lying about reports. The Consumer Financial Protection Bureau (CFPB) charged both Equifax, Inc. and TransUnion with deliberate deceit of consumers about the value of the credit scores sold, as they were caught providing different scores to consumers than what was being provided to lenders. They were also charged with deceit by charging recurring fees to those enrolled in trial services. The agencies were required to pay $23 million in fines and restitution. Equifax agreed to a settlement of $575 million with the Federal Trade Commission, the CFPB, and states related to a data breach that occurred in 2017, where 147 million people were affected by their personal information being exposed. In 2020, a Pennsylvania man filed a lawsuit against TransUnion over being mislabeled as a terrorist due to having the same first name as suspected terrorists. This was not the first instance, as similar events occurred in 2007 in Colorado, where a woman's credit report labeled her as a drug trafficker, and in 2017 in California, where multiple people had their credit reports sold to a car dealership that labeled them as terrorists.